Now you see in this, we'll try to understand the concept of asset securitization further, with special reference to the various attributes which are supposed to be looked at, the type of cash flows that you have, and the structuring elements. Okay, so if you go again in this section, we'll try to see these things. Let's go forward. So what are the various attributes of assets that are supposed to be securitized? You see, it may be something which is monthly mortgage payment. It may be something where you have regular repayments. So that is what is like being bundled up together. Credit card outstanding value means you have this instrument is revolving nature and can be repaid periodically, or it can be receivable of utility companies like payment of bills, electricity, water, etc. So the you see, in case of water attributes, these are the five dimensions which are very important. Any portfolio of asset means, let's say a bundle of loans will have these elements for sure. First is like quality of underlying asset means, let's say if it is a bundle of education loan, 100 or 500 education loan together, what type of asset class do they belong to? Is it standard? Is it substandard? Is it doubtful? Is it loss? Like according to the quality of asset, you see, you have your element of security. So high risk takers, like this is that type of investor who are willing to go into very high risk, where probability of default is very high. Okay, and discount rates are also very high. The second dimension, when we are looking into a portfolio for purchase purpose or for investment purposes, like what is the size, average size of receivable? So you see, let's say we are dealing with a bundle of 500 loans, but what is your average ticket size of this loan per person? You see, it may vary. Yani you may take small ticket, you may take big value loans only bundled up together. So you see, it also influences your investor, okay, and their inclination towards this particular instrument. Now, next is like periodicity of the future receivables. Is it monthly? Is it quarterly? Is it half yearly? Is it annual? The duration after which they are expecting their returns will also influence the investors' like interest into your particular security, which is like through special purpose vehicle you are coming up, you're bringing in a new instrument which is actually tradable in nature, where a specialized body is there which has been hired by a bank to develop this special purpose vehicle, and then they'll give you surety for your recoveries. So as a risky investor, you will put in your money and they are going to give you surety that your money will be repaid back to you with good amount of return on it. Next is homogeneity of the asset. What it means ki, like what I was giving you an example is like we are bundling up education loan, vehicle loan. I was giving you one type of loan in one class. I'm not mixing it up together. Now you see here what we are looking is like, let's say I'm dealing with a bundle. Now this bundle is a mix of everything. It's very complex to deal with. But let's say if it is only home loan, 50 home loans together, or let's say 105 home loans together, or 250 educational loan together. You see, I know this particular loan class. I know the traits. I know what type of challenges are there in this particular sector. I know how they will be giving some sort of return back to the lender. You see, if I am dealing with something called as homogeneity, any the type of loan which is similar or of similar nature, means it is easy for me to manage. But the more type of varieties are added to one portfolio means it is more complex. So according to the homogeneity of asset, that makes my portfolio, you see, it sometimes motivates or demotivates your investor. And last is like, you see, you need to look into maturity composition of your future receivables against those assets. Like let's say I'm investing my money now, so when I'm expected to get my regular periodic interval, this is one, and second is like when I'm going to get my maturity. So these are the five dimensions which are to be kept in the mind of a investor, or like someone who is designing this special purpose vehicle, this instrument, which is like a securitized asset class. You see, investors will be coming with various attributes. What you need to do is like, if you keep these things in mind, your product development will be such where it will be easily subscribed. Let's go into a diagram. Now you see, can you see this special purpose vehicle in set, which is nothing but it is a portfolio of various loans which are going to be securitized. And you see, these every loan is having some sort of collateral associated to it. These collaterals act as a like associated receivable which can be recovered in times of emergency. Here one tag is attached to this component which is quoting as discounted value. Means what it means, these receivables are having a future value, something in future, distant future. Now you see, if you try to calculate those future values into present value, you need to apply discounting. And this element of discounting is going to be heavier if it is a default case. If it is a normal case, you get normal discount rates. But if it is a risky asset, you have to apply for higher discount rates. Okay, with this, your portfolio is ready. Now, who is developing it? It is actually a bank who is called as an originator. So, financial institutions as an originator will be having these big portfolios with different types of discounting applied and some sort of securities involved. This is now under special purpose vehicle. What these banks will do is like they will try to sell it off to someone who is a potential buyer. And these portfolios are actually backed by securities. These are asset backed securities, which earlier was of no use to bank, but now the type of security that you have created is actually backed by some security, is actually guaranteed by some specialized body into market like asset reconstruction fund. So they are going to buy it from banks, and then they are giving investors a surety that they will be getting at least 100 to 100% of their return. So high risk high return probability is taken into consideration. And you see, if you go to investor class, you'll find some investors are always willing to take high degree of risk in line to high degree of compensation. So you see, this risky segment is always willing to come in, and they are going to give an escape route to banks, conventional banks. So even though it is a toxic investment tool, but you see, people are ready. Okay, cryptocurrency is very risky, but still people are coming in because you see, let's go in further into this example. So in this case, there are total 1,000 loans which are bundled up together. Loan average ticket size is between 10,000 to 40,000. Individual loan range, huh? This is what we were discussing earlier into the segment of attributes. So it can vary from 10,000 to $40,000. Okay, this is in dollar term. It can be Indian rupee. It can be any other currency. So average is coming out to be 25,000. So this is your average ticket size, loan ticket size. So these are all small ticket loans. Total loan portfolio is 1,000 into 25,000, which is 25 million. So you see, your total portfolio is 25 millions, which is split into 1,000 cases of average 25,000. Okay, so now you see, this is what is like you do have a backup in terms of portfolio, and now you are going to issue new securities in line to this backup assets. So how many? You are going to issue 12,500 asset backed securities where face value is 2000. You see, you are just giving an equivalent to 25 million. Okay, and this is actually a different instrument where people are going to invest, and when they are making an investment now, these specialized recovery teams will try to recover as much as possible. They'll try to facilitate. Sometimes you get lump sum, sometimes you get regular repayments, whatever is your interest, according to your interest of like repayment expectations. You see, you can be put into a particular class. Now this is the best example. Here you see, special the half of the diagram is already explained, now half is required. You see, escrow account is a neutral account where you are putting in all your recoveries from these defaulting accounts. Recovery in the form of like any client paying you EMI, someone is paying you one time settlement, whatever dues are being collected will be put into escrow account, will be used for repayment of investors. Okay, so in terms of repayment, you have two models. One is pass through and second is pay through. In pass through, what you do is like whatever you recover, you'll simply pass it to the investor class, the new investors, the new owners immediately. Or second, it can be a pay through. Pay through means you have fixed dates on which there are fixed amount of installments that are supposed to be paid. Yani, you see, they'll recover it, keep it in an account, and whenever their maturity date comes in or their repayment dates come in, they are paid in installment. So you see, whatever model is preferred by investor is actually used for repayment purpose, and this is actually a win-win situation. Banks are winning it, investors are getting it, a benefit out of this, and then assets are getting securitized. Okay, so this is cash flow and securitization. So there can be multiple stages actually. First is initial cash flows, followed by reoccurring and terminal. Terminal means in the last. So originator is going to get these cash flows, and when they are supposed to negotiate with potential new buyers, they have to showcase it to them. Like, what are you going to get in first? Okay, then what are you going to get over a period of time? Reoccurring nature, which is repetitive. Okay, and then what are you going to get as a final maturity value? So these are the different type of cash flows which originator can showcase it and can be used for marketing purpose and can be showcased to the potential buyer. And if buyer is interested looking into these cash flows, so is all great. You see, they'll be happy to come in. And now this is the entire structuring of a securitization of a portfolio. Now it involves the various steps. First is like you will try to set up this entire mechanism of securitization using special purpose vehicle. You'll do your initial scrutiny. Then you'll be going into like appointments, which include investment bankers, credit rating agencies for rating your instrument, then legal advisors. You bring them all, you give them their assigned task, and then get it done. Then followed by asset analysis and selection of a portfolio. You see, you finalize it, you select your portfolio, you buy it, and once you buy it, you see from where are you buying it? It is bought from the money of potential investors. So investors are pulling in their resources. They are giving their resources to you as an advisor, and you are going to use that money to buy these portfolios. And how you are doing it is like after the consultation with your all expert teams that you have, you do it. And then legal and financial viabilities are checked. Once it is all finalized, due diligence, whatever documentation has been done, again we'll do an audit so that nothing is kept pending. So after this, you see, you'll do credit rating for your instrument. Credit rating means is only to give boost to your investors that this is actually good quality instrument. Okay, this credit rating, like you see, mess up was seen in subprime crisis, but it was in a negative sense that even though instruments were rated very strong, very good, but later on they all failed. So you see, everything is possible. So this is just to give you some sort of confidence into your investment. Then determining the structure involved, what type of payments are you involved in? Is it pass through or pay through? Is it pay down structure? Is it credit enhancement in between somewhere? Like new set of loan portfolios will be acquired over the long tenure. Or then what type of SPV are you going to constitute, the structure and the responsibilities of different parties. Now you see, this is what you have in your determining the structure. And finally, you are fixing it up, appointing the servicer or administrator. You see, bank is going to act as an administrator, bank is going to act as a facilitator in the process of securitization. So even though the ownership has changed from bank to a third party, but you see, bank's role is still very important because they are able to recover it easy, and they are going to act as a facilitator for which they may charge you a facilitation fee. Okay, with this